to the August Wealth Advisory Review, where we take some time to review ways to create, grow, protect, and preserve your family's wealth. Got a good program tonight for you, and I'm looking forward to sharing with you some of the good news that we're finding in the markets and the economy. And so we're going to go ahead and get started right away. As always, a quick reminder of the important discussions that we're having here. We're going to be talking about investment ideas, tax ideas, planning ideas. And so please make sure that this fits within your thing. Just because we tell it to you here does not mean that it's something that fits for you. We share a lot of information with a lot of people, and we're trying to cut the widest swath through humanity we can. And so always confirm that what we're talking about in this podcast makes sense for you and your situation. If you have any questions, you can certainly reach out and be happy to confirm for you whether or not this is a good idea for you. And of course, you should check with your CPA, your attorney, any important decision makers in your family to help decide what makes the most sense for you growing your family wealth. We'll take time for questions as always at the end. You can either chat your question and I will look for it at the end of the presentation, or you could even, if our system is set up with your system well enough, even ask your question live. And so we can try that. You can raise your hand and we'll see if I can make it so that you can talk on the broadcast. Sometimes it works, sometimes it doesn't, but we'll give it a shot. But the chat will always work. So feel free to put your questions there if you'd like to. Tonight, we're going to cover a number of things. We're going to take a look at the market and economic data. We're going to take a look at the difference that we bring to this discussion through the IXL financial dashboard. I'm going to talk about the Trump presidency and how that's impacting family wealth. Take a look at the One Big Beautiful Bill, or what's more technically known as the Tax Cut and Jobs Act, and how that could impact your family wealth this year. Take a look at our third trimester year-end planning for taxes and estate design. I'll talk one more time about our big announcement. I shared it last month, and I want to share it again today because it's all come together now. So, and then I'll take that moment for your questions at that point. So, just a quick reminder: when we're doing wealth management, we are a shop that tries to help bring together all the pieces of wealth management, not just in planning or insurance, but also investments. And within investments, we take a look at items, as you can see on the screen here: cash, bonds, stocks, real estate, tangible assets like energy, metals, commodities, currency, the US dollar against the world, business interests, which could be more private programs designed for people that have $1 million of net worth, not including their home, and then insurance and annuity programs that can be appropriate for certain individuals with either income or wealth risk tolerance issues. We want to make sure that they don't put themselves in a place where they take more risk than they feel comfortable with. And sometimes insurance and annuity programs bring a piece to the table that we can't get with other investments. So this represents the 8 different investment categories we work with, and all of the details below each category, the subcategories and so on. We bring those to the discussion as well. So let's take a look at the markets in general. I'm going to go ahead and skip to the live program itself online. So here we go. This is live. So we can see what happened as of today, as well as looking back year to date on this. So a couple of things I'm going to share with you. This again, let's confirm it is year to date. Nope, it is 1 year. I thought it looked like it went back further than it did. There we go. So on January 1st, back in here, this is where we started. We obviously had a high, an all-time high at that point for the S&P 500. Then we had the market go down, start to come back up. Then we had Liberation Day, where President Trump talked about the tariffs and how he was going to try to create balanced trade agreements with the rest of the world. Market really tanked on that. I'm very concerned about what that would mean and how that's going to work. But from that point forward, we've had a pretty continuous upward swing with the S&P 500, as well as the NASDAQ and the Dow, some doing better than others. But it's been a continual upward trend, as you can see here. We've had a little bit of pullbacks along the way, but nothing significant yet. And it's bringing about a lot of excitement and exuberance for where things are going. And to me, that's a concern. Whenever everybody's thinking that it's time to invest more, it's probably time not to. So we're watching for some pullbacks. I don't think they're going to be anything significant. I think as we look at the economy and the markets in general, I think we're looking at a very good end of the year. However, having said that, that doesn't mean we won't have some volatility along the way. And so we're watching for that to look for opportunities to help clients with some extra cash, put that to work. And so rather than just put it in the market now, we've got a lot fully invested, but we also have quite a few that we've held back some cash for that moment when the market pulls back. And I think we can see that from there. That's a possibility. Matter of fact, if I take this and now change it to the last 15 days, and we'll look at this on a different measurement, not the daily activity. You can see that over the last 15 days, we again had another all-time high. Then the market pulled back. We have been working our way back up, and that's a very good sign. I will tell you, I'm excited that it is doing that, although I do wish that we could get some more pullback so we put some of that last bit of cash to work. But having said that, I do think that we're looking at a pretty good market here, at least for the short term. I would point out that historically, August, September, and October tend to be times in the market where it does get a little volatile. There can be some pullbacks. Those might be only 3 to 10 or maybe 12%, but that can happen. But taking that last bit of cash and buying in at that point gives us a little bump up for those accounts where we have some cash sitting out there that we've been waiting for this moment. Because if it has another V-shaped recovery and returns back up that 5-10%, that's just extra performance on that money. So we're working for that for those clients that still have some cash. But for the rest, we're fully invested and looking forward to seeing how this is going to work out. I personally, and I have no guarantees either, but I personally am expecting this year to end out with either high single digits or low double digit returns in the major markets. So I'm pretty happy about what we're seeing here. When we look at the markets, whether they're overbought and oversold, right now they appear to be a little overbought, which means that could help us with that pullback. But again, at this point, haven't seen anything really significant yet. If I go back here to this all-time high, and I got to turn on the annotate again. If I go back to that all-time high, and I take that from there to this recent downturn, that's only about a 3.2% drop in the market. Let's hope for a little bit more than that, because I think it could be. But nonetheless, we are feeling very confident. I am feeling very confident about the markets and how that's going to impact you, your family, and the wealth growth you're seeking as you look forward here. Another couple of pieces to look at. If we look at the S&P 500 and the 11 industries that it represents, and we compare that to the S&P 500, which what that means is this little straight line right here, this very straight line, that represents the S&P 500, and it shows us which different industries are outperforming the S&P 500. If I put it this way, it might be a little easier to see that. What you identify here is technology and industrials are the only thing that's outperforming the S&P 500 right now. I would also put in there, though, that communications and discretionary spending are not far behind. And so what that would tell me, if I'm treating that as our sector rotation indicates here, technology, communication services, industrials, discretionary, we are still in that point where we have a market expansion still coming. We still have more opportunity here, which is another reason why, even if we do have some volatility, I think we're looking for some great opportunity here over the very short term here, even with that volatility. As the market matures, we might start to see some of these other asset groups kick off. But until that time, we're going to stay as we are. And unless you have any questions or concerns about that, we're going to continue on that model with your wealth management. And if you have questions, give us a call. We can talk about that as well. So for now, we're looking at a very good approach to the markets and the economy. Let's take a look at it from a different angle. If we pull up the market carpet map we're looking at, we can see again those 11 industries. We have it set for year to date. So you can tell that, for instance, technology is up 16%. As I was just showing a moment ago, it's up 16% since January 1st. That's pretty good. 16% over here for industrials, as I was saying a moment ago. Financials up 9.59%. You can tell here just some of the various ones. Communication services, which kind of fits in that technology model, also up for the beginning of the year. Utilities have still held their own pretty well. The only things that sort of had a problem, healthcare has been problematic, and so has energy been problematic, but not terribly so. But these are pieces that make me think again that from year to date till now, these are very strong indicators that the economy and the markets are going to do well. Last thing I would look at would be how some of the various models we work off of. This represents our asset allocation modeling, identifying an aggressive growth approach up here, a conservative growth approach, a moderate, and then a conservative approach. And as you can tell, those are from year to date still in very nice territory, up anywhere from 7% up to 12%. And so that's a very strong performance on those asset allocation models. If we want to take a look at that and say, well, how about certain asset groups? Let's change this back to year to date. What we can see is items, for instance, like Bitcoin and gold have done well. If we take a look at items like the NASDAQ or S&P 500, if we take a look at world stock, including, turn this off so I'm not blocking your view. We take a look at world investments, not including the US, also very strong. So all of these items represent great opportunities that really feel like we've got some momentum, which is a big player in the issue. If you got momentum, it makes you have confidence that you can move forward with some confidence. And I think all of this supports that thinking. So if I put all these pieces together, I would tell you, I feel like we've got a great opportunity ahead. And now it's just going to be a matter of letting it do its job while we help you make the most of that. But with that in mind, let's drop down here now to where we stopped. So as I've shared, I think every month since March, just as a quick reminder, the President Trump's first presidency was marked with a lot of volatility. We had 2 market corrections of 10% or more, and we had 2 bear markets of 20% or more. So 4 total market events during that 4.5-year period of time. That's a lot of volatility. But having said that, from the beginning of his term to 6 months after the end of his term, the market was up 87%. That would mean that if a person had $100,000 invested in the S&P 500, it would have, even with all that volatility, be worth $187,000, almost double at the end of that 4.5-year period of time. I tell you that not to say that's what's going to happen again, because quite honestly, we don't know what's going to happen this time. But because he's a disruptor, because he's constantly changing the conversation, both nationally and individually, because he's bringing new ideas to the table, that creates market volatility and fluctuations. And so if we compare that, for instance, to where we are now, we've obviously had a big downturn and then a big upturn, a very strong V-shaped recovery. I think this is a great example. And just for the record, that's almost a bear market right there, 19% down. That would certainly be a correction. And so we could say, well, that's the first one that's happened. And we'll see what happens between now and the end of his presidency. And while there's no guarantees we're going to see the performance that we saw last time, I think it is encouraging when we take a look at how all the pieces are flowing together right now, that it gives me a lot of hope that we're going to see some very good performance over the next 3 or 4 years now. Along with that, I would tell you that I've talked to many of you, and I hear sort of the same thing in all these conversations. Item 1, I just want to make sure that we get the best deal we can by trying to take advantage of these pullbacks whenever they show themselves. If you're fully invested, then all we can do is make adjustments to different asset groups that work better. If we have some cash, we can then take a look at that. I'm not a big believer in timing the market, but I can tell you that when we had this downturn back here, for clients that had brought quite a bit of cash in, we began slowly investing. It took us about 4 different times to put money into the market as we saw each of these pieces happen. It's not because you can buy it, call it right, and make that happen. That's not what this is about at all. This is about identifying an opportunity to take it when it's down 5% and buy it when it's on sale. Whether or not it's going to go further down or whether or not it's going to turn around and come back up, that would be market timing. That's impossible. We can't do that. I know maybe you think you can, and if you can, more power to you, but I would never claim that we can do that. But I can say that if I feel fundamentally the economy is strong, technically it looks like these asset groups, whether they're stocks, industries, indexes, if those look like they're in an upward trajectory and they pull back a bit, to me, that's an opportunity to catch something on sale and continue to work things out. Conversely, if the market falls and it breaks through some of its moving averages, those are times when we reconsider whether it might be time to pull back. Not timing, but rather to grow and then protect. And so when we do this trend sort of behavior, it's all about trying to grow wealth and then protect it, grow it and protect it. And so with that, we get it right and we get it wrong sometimes. But we're working hard to help you take advantage of these opportunities to make the most of your family wealth. So as I said before, President Trump is a volatile guy. He says a lot of things. He creates a lot of disruption in the markets and the economy. Be prepared for that. But I said before that the one thing I keep hearing from people is look for opportunities. But the other thing I hear is they're confident that going forward is probably going to be okay. And so we're working off that model as well. But as always, if we think things are changing dynamically, we will be prepared to make adjustments accordingly. And I would always say to you, if you have questions or want us to do something differently, talk to us. That's what we're here for. You're the boss. We're the employees. Our goal is to try to help you understand what's going on and then implement in the strategies that feel best to you. So President Trump's presidency 2.0, I think, is looking good so far. And we'll see how it goes here as we go through the rest of this year and into next. So as I've shared with you before, we are working hard to always be client-driven and advisor managed. That's our primary goal here, which reminds me to share with you again the 3 phases of your financial journey. The first phase is the pre-retirement or accumulation phase. And many of you are in the accumulation phase right now. You're climbing the mountain, looking for a time to plant that flag at the top and then retire. Whether or not that is 5 years from now or 25 years from now, you're still looking for that moment. Some of you on this call, you are at the top of the mountain already on the other side of it now, and you're in the post-retirement or decumulation phase. And so you are already moving down the mountain, trying to pull out income, make sure that your planning is going to last and your money's going to last as long as you do. And so that's another part of the equation is our financial planning is to think pre-retirement, accumulation, post-retirement, decumulation, and how to make sure your wealth lasts as long as you do, and then you can pass as much of it as possible on to your loved ones. Third phase is that death or transfer phase. I know that nobody on here is in that phase, otherwise you wouldn't be here. But that is the phase where you transfer that wealth to your loved ones, the people you care about, not the IRS and not state government coffers, but rather to the people that you care about. And so as we build your plan and help you put together that process for accumulating and decumulating and managing wealth wisely to make it so that you can transfer it to your loved ones. And I know that there are a couple of people on here who they are the recipients of that transfer. They're benefiting from what their parents did. And so to that point, their goal was to make sure that you have the resources to do what you're doing and that you can then maybe do this again for their grandchildren, your children. So these are the 3 phases that we look at. Now, having said that, I shared this, I think I shared this over a year ago, but I've been doing the prep for today's meeting, or I was reminded of it again. I don't know about you, but when I was a kid, we played Monopoly a lot. I don't know why we did. I guess because I found money and finances interesting back then as well. But we played Monopoly a lot. And when we were playing Monopoly, there was a couple of rules that you learn. And you learn to buy properties, you learn to get houses on those properties, and then hotels on those properties to make it so you could make money. So you were doing more than just collecting that 200 every time you go around go, because there was no way to win the game if you did that. Yet, I can tell you, I see people all the time who don't understand how to do that. And not just a handful. If I lined up 100 people, I'd say realistically, you'd find that 20, maybe even 15 of them are actually playing Monopoly right, and the rest are not. To that point on the screen here, you'll see, imagine playing Monopoly and never buying any assets or investments that generate income. Imagine you just went around collecting your $200, paying taxes, giving your money to the rich, and trying to stay out of jail. That's how most people live their lives. You being on this podcast, I know that's not who you are. But if you know people that are, remind them that you can't win Monopoly by just going around the board, collecting your $200, giving money to those who do have assets, and trying to stay out of jail. If you're going to win life in general, you're going to have to plan to manage resources wisely. And so that's what the 3 phases are about. In the accumulation phase, you're building up your properties, your hotels, your houses on the game of Monopoly. But then as you start to get to the end of the game, you're going to be pulling money out, living it, doing the things you want to do, maximizing your retirement, maximizing your return on your lifestyle to enjoy what you have and what you build up. And then finally, unlike the game of Monopoly, when it's over, you're not going to put the money back in a box and put it in the closet. You're actually going to be transferring this to the next generation. And hopefully they have thought how to play the game well. Hopefully they're listening to your counsel and making good decisions. And that's why I remind you of this, because I think this is an important piece to winning in life as well. As we take a look at that and try to put that into a planning perspective, we take a look at what a person's lifetime portfolio will look like. And that's what the blue bars on this graph represent. The blue bars are what is happening to your lifetime portfolio over those years. And as you can see on there, there are 3 different curves for that retirement. The first curve is a red curve, where you run out of money before you run out of life. That's what poor planning would do. It'd make it so you wouldn't have enough financial resources, so you wouldn't have enough capital. You may still be receiving Social Security or a pension plan, but you wouldn't have any more capital or cash or investments to pull from. The next line I point to you is the green line, the runaway green curve, which is a curve that simply shows for that person who their wealth just keeps growing over time. In some ways, financial planning is incredibly complex and difficult, but in other ways, it's actually simple. And if I were to put it as an equation, I would say your income minus your outgo against what you own versus what you owe. And as long as those 4 columns add up properly, you're going to create a runaway green curve. If those 4 columns do not add up properly, you're going to end up with a red line that runs out of money before you do, before you run out of life. Now, in both cases, we try to actually change the thinking to create what we call a healthy purple curve. And the purple curve is this: not that you die with 5, 10, 15, 20 million in your coffers to then hand to the next group. Not that I'm opposed to that. I think that's a great thing. But if you wanted to actually enjoy life more, maybe do some of the things on your bucket list, or what we call your life goals. If you want to do some things differently, then maybe you could do some giving while you're living. Maybe you could do some enjoying while you're going. And that's part of what the return on your lifestyle is about, to create a healthy purple curve. If you, on the other hand, have a red curve where you're about to run out of money before you run out of life, we want to help you extend that as far as possible to create a healthy purple curve that you can feel confident in as you plan for the future. That's what we're doing. And not only do we build your baseline financial plan for that, but we also stress test it. You'll notice here at the top, it says, during your ideal retirement, well, what about if you have a less than ideal retirement? What do you do then? We got a plan for that. That's why we stress test it against some other problems that could happen. What if you have a disability before you retire, or long-term care need after you retire? What does that do to the family finances? And what if a spouse passes away prematurely? What does that do to the family finances? That's how we stress test a client's base plan to make sure they have enough resources to create that healthy purple curve at the very least, and then enough resources that keeps that healthy purple curve working, even if a less than ideal retirement happens. So that's part of why we put so much energy in the financial planning discussion, to help clients create a positive income gap and a positive wealth gap, and to avoid anything that will create a negative income gap and a negative wealth gap. To that point, we provide the clients who utilize our planning services with an IXL financial dashboard. And the purpose of this dashboard is to help you be able to consolidate all your information into one place where you can see it at a glance. Just like the dashboard on your car when you're driving someplace, checking speedometer, you're checking if there's any red lights on for oil pressure or other problem. You're looking for directions and making sure that everything is running like it's supposed to, your blinkers, your indicators, and everything. So this dashboard works the same. It's designed to give you the resources to look at those 4 categories again: income, outgo, what you own and what you owe, and determine if you're going to have the right kind of portfolio value for your lifetime to meet your needs, both now and in the future. To that point, as you already know, what we do in our planning for people is we break the year up into 3 components. The first trimester, first component, is spring planning and review, renew. To take a look at what we've done in the last year with you, what you've done in the last year, and then what we want to do this coming year as we go forward. As we get into middle of April to somewhere in the middle of August, we then do in the second trimester investment and insurance review, making sure that your investments are on target to meet your goals. We've got a good plan, looking at how your planning is set versus how your investment management is working, both investments with us and investments outside of us. And then also insurance review to make sure that you have protections in place if necessary to meet against any catastrophic things that could happen against income or assets. And so that's what we do during the second trimester. And that's what we spent the last 4 months doing, is meeting with clients, going over their planning for income and investment review. And then finally, in the third trimester, that's when we take a look at your tax review and your estate design and your financial plan. If you're utilizing us for financial planning services, we have resources to help you take a look at your tax return, figure out where you are this year compared with last year, where you are with your estate design, how does your will or trust, how does that fit within the distribution model you have, what are the expenses associated with taxes, what are the expenses associated with estate design, passing on assets, where you're going to be giving money to family, to ministries or charities you care about, or you're giving it to the government, or legal fees to other people involved in the process. And if that's okay, you're great. But if not, we want to show you how to find ways to improve those items as well. So between the middle of August and about the end of November, somewhere early part of December, we'll be meeting with all our planning clients, taking a look at their income taxes, both current year situation, meaning this year as compared to last year, and then also looking ahead a bit to see what kind of income taxes we're facing or they're facing over the next couple of years, make sure we can start putting plans in place to do anything possible to minimize that. And then also take a look at their estate design, potential costs there, beneficiaries, to make sure that with their investment accounts and insurance accounts, they match up with what their estate design says as far as who's supposed to get what. And so we're going to be talking more about that over the next month as well. So again, if you have any questions on that, we'll be calling you to schedule your meeting. If you want to get together before that, feel free to give us a call. And if you're not really sure about all this, give us a call and we'll show you how this works. So now that brings me to kind of a setup for this third trimester, which is a year-end tax planning checkup that we'll be doing with any of you who have our planning system in place. I don't know if you remember, but President Trump put together the One Big Beautiful Bill. And that really was also known as the Tax Cuts and Jobs Act. And what we're going to do is take a look at some of the aspects that have come off of that for you. Now, again, as I mentioned in the earlier disclosures, this information, I'm not a CPA. We do a lot of work with items like this, but you would want to make sure your CPA is looking at your situation to make the most of it as well. We do our best to help you plan for it. But quite honestly, some of our clients actually go back and talk to their accountant as well. Once we put together some items that they can show the accountant, go back and make sure that everybody's on the same page. And so with that in mind, here's some things that the Tax Cut Jobs Act bill that just was passed says. So here we go with a couple of items. This right now, we'll start at the top. Most tax cuts are now permanent. I don't know if you follow this. If you're not a nerd like me, you don't read this sort of stuff. I can tell you that all of the tax cuts that President Trump put in place in his first presidency were about to come off the table. They were going to change. And so what he did was he made them permanent. So now I'm laughing because there's nothing that's permanent in Washington. They did make them permanent, so it's no longer a 10-year sunset. That's all true. But honestly, if the next president gets in office and says, I want to raise taxes or lower taxes, they'll pass new laws and it will change everything. So to be fair, it's permanent until the next president comes along, the next administration wants to change things. And I'm going to show you in a moment what the top rate is and all that, how that fits in a second. The standard deduction right here, standard deduction is not only kept, but it's increased, meaning that if you're a married couple filing jointly, you can claim $31,500 for 2025. Now, if you have itemized deductions that are greater than $31,500, you can certainly use those. But for many people, they don't even have $31,500 in standard deductions. So this is a nice way for them to lower their tax bill because they get to deduct $31,500 off of their adjusted gross income. That's a pretty cool deal. Alternative minimum tax, it's still in place. So you can look at how that may or may not help you depending on your situation. And the child tax credit is also still in there and actually boosted, increased a bit. Again, if you don't have children, don't worry about it. If you're not in a situation where AMT is an issue, don't worry about it. But if you are in any of those situations, just be aware it's still there. For those of you who are in states where there is a state income tax, Florida is not one of those states, but I know that we have a number of clients who are in states where they do have state income taxes. There is the state and local tax or SALT deduction limit, and it's actually going up. Currently, it's at a rate, I believe, of 10,000, but it's going up to 40,000 starting in 2026, and it will increase by 1% a year for every year until 2030. And so what this simply means is if you're paying state and local taxes, you can use that against your federal taxes as a deduction to make it so you're not double taxed. That's what the purpose of that is. Of course, after 2030, we don't know what's going to happen. That may stay or may go away. If it goes away, you probably should move to a state like Florida where you don't have to pay taxes, state taxes. Just a thought for you. But for those of you who want to stay in those taxes where there is, those states where there are state income taxes, that's also fine as well. For higher income households, this deduction limit will be reduced sooner due to income phase outs. And that's where you're going to have to, and I didn't put anything on there because it's going to depend on various states and how this is impacted within your federal taxes. So just keep that in mind as you prepare for the year that you get this nice benefit, but you want to make sure how you high income earners are going to be able to take advantage of that or not in case that's an issue. For 2025 through 2028, 3 temporary above the line deductions now exist. One, if you are a service worker and you're getting tips, you don't have to be taxed on them. 25,000 of qualified reported tips are now, you get a deduction for that. If you have a modified adjusted gross income of over 150,000 as a single or 300,000 as a married couple, you may not qualify above that level. But if you don't have that, that's an awesome benefit for tips to be tax-free to you now, and you can claim those. Certain service businesses don't qualify. That again changes from various locations. So please double check with your accountant to figure out if what you're doing does qualify for that. Additionally, no tax on overtime. For those of you who get to work extra time and a half, the half is now tax deductible, at least up to $12,500 for a single or $25,000 for a married couple. So the extra time and a half, you can make up to $25,000 and not have to pay taxes on that portion as well. Again, single is $12,500, married is $25,000. However, that same income limit of $150,000 or $300,000 may apply as well. So again, talk with your accountant to make sure that that works correctly for you. New thing, I remember when it was taken away, I didn't like it, but it's now kind of back. It's actually President Trump, I think, who took this away. You now get to deduct the loan interest on your vehicle. Up to $10,000 of interest is on loans for new, personally used, meaning not business, vehicles made in the U.S., not foreign cars, but U.S. cars. Again, he's trying to get people to buy America and make America great again. So if you have purchased a new car, it's U.S. and it's for personal use, not for business, you can deduct up to $10,000 of that money, or that interest expense. It does have phase outs, $100,000 for singles, $200,000 for married couples. It also has to be a loan right here that you did after December 31st, 2024. So if you bought a car in 2023, in November of 2024, you won't get to deduct that interest. That doesn't mean you couldn't go out and do a refi, but again, talk with your accountant because there are certain requirements here. Lenders and the vehicle's VIN number must meet certain requirements. And so check with the people involved, whether it's your lender, your accountant, make sure that you have the right situation because you want to make sure you can actually deduct that if possible. And if you bought a vehicle before December 31st, 2024, you want to make sure that if you're really serious about this, you put everything in right order so you're not surprised later on. Next, some other things from the One Big Beautiful Bill that will be helpful to you. For 2025 through 2028, taxpayers age 65 or older can claim an extra $6,000 deduction. This benefit starts to phase out when your modified adjusted gross income again is over $75,000 as a single, $150,000 for a married couple. You had heard some things. Maybe you picked up on that Social Security was now tax-free as long as you made less than 150 as a married couple. That's not true. It is not tax-free. What it is you get a deduction. And as long as you qualify for that deduction, that $6,000 deduction is designed to offset the taxes on the Social Security benefits. So again, it's kind of straightforward, but not really. So you want to make sure that you got everything planned out carefully to make sure you can get that deduction and that everything's going to work out well for you. Because getting your Social Security benefits basically tax-free because of a $6,000 or some version of that deduction, that's a pretty cool idea. So keep in mind, that could be a possibility for you as well. If you are a business, you own a business, and you've got certain provisions in your company, investments and so on, here's some rules for you. And I know we've got business owners and entrepreneurs there as well. Starting January 2025, businesses can claim up to 100% bonus depreciation on qualified property, and the rules now cover certain types of production equipment. That could mean certain types of equipment you use in a factory, certain types of equipment you use out in the field, but you have to check through that and see how that works. But that depreciation is now another opportunity to help lower your reported business income. Another one, you got an interest deduction limit. It's relaxed. Now the adjusted taxable income is calculated before deducting depreciation, amortization, and depletion. And again, that's a very complex conversation. I would highly recommend you talk with your accountant about that. If you're a business owner for, say, you're filing a Schedule C or an LLC, a Sub S, or a C Corp, make sure that your situation would allow you to take advantage of that. And I'm sure your accountant will have some great answers for that. The 199A deduction, allowing certain pass-through business owners to deduct up to 20% of their income, is now permanent until the next administration decides to change things, but it's permanent until that happens, and higher income limits before restrictions apply. And so it's actually making it so you can pass through income. Certain types of Sub S and certain types of LLCs, as well as other models, could help make this useful for you. So again, talk to your accountant to make sure you got everything set up properly for you, because the end of the year is coming and December 31st will be here before you know it. And if you haven't set everything up properly, you're going to be like, I wish I had done it sooner. So please, that's one of the reasons we talk about this. What is it? It's August right now. Make sure you've checked on it so you actually will get the full benefit of that if available to you. Domestic research and development costs can be fully deducted in the year they're incurred, reversing the Tax Cut and Jobs Act rule that required them to be spread out over several years. Now you can get a bigger bang for your buck on certain types of development and research. Again, very specific rules. Talk with your accountant to make sure that what you're doing would qualify in that. But that means that instead of having to spread out, say, a $10,000 expense or deduction over X number of years, now you can do it in year one. And that can be a heck of a deal, especially as you get to the end of the year and you're like, oh, I've got a lot of income to report. I'm going to use this to help reduce my tax bill. You may or may not have known it. We're moving on down here to get estate and gift. The estate tax exemption has been increased and made permanent. You may not have known it, but in 2026, there's supposed to be this reversion that took us back to a much earlier time and a much lower transfer of assets to family at that transfer time, at the time of passing. This now makes it so that is permanent until the next administration changes it, but it's permanent until that happens. And it extends and expands the amount you can transfer to loved ones. And it's a pretty healthy deal. As a matter of fact, if you have to adjust your tax, your estate plan, your estate design, this may be a great time to do it, because wealthy families can update their estate plan and take advantage. It creates a strong incentive for that because it maximizes out what's called your unified credit, which is almost like a tax deduction, but it's applied to your estate plan rather than your income taxes, your 1040. And so consequently, this is something definitely we'll be talking with our planning clients about to see if there's any real benefit for them to take advantage of this and make use of it, make the most of it. So what are some practical planning notes? What you need to know, take a look at the advantage of the temporary deductions for tips, overtime, car loan interest. If you qualify, make sure you got all of your ducks in a row. You got all the information needed so that you can qualify for this, and understand this is 25, 26, 27, and 28. So if you're going to do it, take care of it in these 4 years, because this is your opportunity It might be made permanent after that, but it might not. So don't miss it if you can use it. The SALT deduction, or the state and local tax deduction, caps at 40,000 until it drops back down and will increase each year by 1%. So again, take advantage of that as long as you can. For business owners, now is a good time to review whether operating as a pass-through or a C corporation makes the most sense. If you're saying, I don't know what those are, and you don't own a business, don't worry about it. But if you do own a business and you're debating on maybe changing your corporate ownership a bit from one style like an LLC or a sub S to a C corp, this might be the perfect time to get that done, especially this early in the year, so you can take advantage of this opportunity. And it makes time also to revisit your estate plan to make the most of the high exemptions that now exist to transfer wealth from this generation to the next generation. What an opportunity. One last thing, not part of the One Big Beautiful Bill, but an executive order that President Trump signed in August this year. Now there is the ability to allow new investment options in your 401k plan. And those investment options can be private equity or alternative and equity investment programs. They can be real estate, and they can be cryptocurrency. And if you're saying, I don't want any of that stuff in my plan, then don't worry about it. But if you do want some of those things in your 401k plan or your Roth 401k plan, it could be a great way to put some of those investments in there and make it so your wealth can grow tax deferred, at the least tax free if you're using a Roth account. What a great opportunity. Again, talk to your employer, talk to your HR department, and see if that is an opportunity you could utilize there. If you're a small business and you don't have a 401k, but you're looking at creating a 401k, this could be the perfect time to have that conversation. We'd be happy to talk with you about it. You can certainly talk to your CPA and try to figure out, would this be a great time? Because for those of you who are thinking, hey, I'd like to get one of these types of assets in my 401k plan, this could be a great way to do that. So my encouragement is, while this is not part of the big beautiful bill, it is clearly an executive order that exists until it goes away, and then at that point you will have already taken advantage of it. So examine it, check it out, see if it works for you. One other thing I will say is that you'll notice I see it. I put down at the bottom. I'm excited about this because it creates more opportunity for investors. But I will also say the critics warn that it could be more expensive, and that is exactly accurate. If you're using certain types of private equity programs, they're going to cost more than the average mutual fund you're going to use inside a 401k. So honestly, it probably will be extra fees. Make sure you thought about those fees to determine if that makes the most sense for you. Also, it'll create more complicated valuations, and depending upon the type of risk you're using with some of these assets, like the crypto or maybe some real estate, that could be more complex for a 401k as well. So there's pluses and minuses. Again, back to what I said a moment ago, check it out. See what makes sense to you for your situation. And if you own a company and you're looking at having a 401k for you and your employees, check it out, see if it fits well with you and them as well. I told you I would share with you the tax rates. I only did the married filing jointly, but obviously there's rates for single, there's rates for married filing separately, and so on. But for married filing jointly, the first $23,850 that you make is taxed at 10% income. The second $23,851 up to $96,950 is taxed at 12%. And that's when they say we have a progressive tax system. That's what that means. It progresses from 10% to 12%, or maybe that's a regressive if you ask me, but it still goes up. And then it jumps 10% from 12 to 22% on income from $96,950 up to $206,000. Then it increases another 2% to 24% from $206,000 to $394,000, 32% up to $394,000 and $501,000, 35% from $500,000 up to $750,000, and then above $750,000, it's 37%. And so obviously, the more you can do to stay down in those lower brackets is essential to making the most of what you're doing. That clearly is something that we would all try to do. And so consequently, I would say when we're looking at this, you want to keep this in mind, because money that you give to other expenses, including taxes, especially if you don't have to, is a way to help keep more money on your side of the balance sheet. For those that live in states with state income tax, that just is additional to that expense. As a matter of fact, if I'm looking at it, if you're looking at your federal tax bill and you have a certain amount that is going to federal taxes, that means it reduces the amount of that money that you're keeping. So if, for instance, your tax bracket is 25% and you pay that 25%, that means 75% of what you made you get to keep. But when you add state taxes on there, that changes it from a low end of 10% up to the high end of 37% plus state taxes as a total of 50.3%, meaning that you're actually giving more to federal and state tax coffers than you're getting to keep yourself if you're at that highest level, which means you have less money to apply towards your goal. So everything you can do in your planning to reduce that is essential and critical. So consequently, I would encourage you to really take a look at your tax planning and make sure that everything is coming together well and involve all the professionals in the conversation, the CPA, the financial planner, anybody who's impacting your wealth management, wealth growth, wealth creation should be part of that conversation to make sure you get to keep as much of that on your side of the balance sheet and not in somebody else's tax category. To that point, I will tell you that since I've been doing this number of decades, sometimes I see people get so excited about reducing taxes that they miss opportunities, that the tax tail starts to wag the dog. As good as any approach is, all these approaches to reduce what you pay in taxes come with strings attached. So make sure that you thought through the whole process, decide if, while the tax benefit is great, the investment benefit may not be as great, or maybe the tax benefit and the investment benefit is great, but the amount of work and upkeep to maintain it isn't great. Just make sure you thought through all the pieces so you end up with the best approach for you. And what are those approaches you can do? Well, before December 31st, most tax planning has to be done. After December 31st, you've got a few things you can do with an IRA, a SEP IRA for a small business owner, but really there's not a lot you can do after January 1st to reduce your tax bill. Yes, you can gather up your deductions and so on, but quite honestly, if you've been thinking ahead of time, I mentioned that, for instance, there's certain equipment you could buy as a business owner that's going to reduce your tax bill. That would be something you'd have to do before December 31st if you're going to take advantage of that. After December 31st, there's really no opportunity to go back and capture that. So in your year-end deductions, you want to try to do the best job you can, pulling together medical expenses, mortgage interest, student loan interest, losses you have, contributions to 401ks, 403bs, 457 plans, health savings account contributions, state and local taxes, education expenses that are tax deductible, home office deductions, self-employment expenses, business expenses. Also, year-end charitable planning, income gifts, asset gifts, plan gifts. And then finally, tax credits where they are appropriate for your situation and available to you, residential income credit or energy credit, child tax credits, child dependent credits, adoption credits, lifetime learning credits, electric vehicle credits, earned income credits, American Opportunity Credit, and Savers Credit. Just various things, and they change from year to year. We have to look each time to see what exists and what does not. But those are some common things that have been around for quite a while. Once you are doing all of this before December 31st, maybe taking advantage of some of these after December 31st, you also start looking for considerations for the future. Qualified plan distributions, Roth versus traditional IRA. There's a huge amount of taxation. And when I've done this in the past, you might have a $1 million IRA, but the IRS knows that when you pull that money out or when you pass away, they're going to get 40% of it. So that would mean that we don't have $1 million IRA. You have a $600,000 IRA, and the IRS is waiting for their $400,000, whether they get it over a number of years or they get it at one time at death. But doing that Roth conversion can cut that $400,000 down to maybe $200,000 or $250,000, or maybe even less, depending on some of the opportunities you have in your situation. So having a plan for that conversion is a critical component to good tax planning, not just in the current year, but in future years as well. Charitable plan distributions. If you have charitable intent, there are certain types of charitable plans you can set up that can give you a lifetime income, that can create an asset transfer during your life, that can then make it so you can do your charitable intent and get benefit for it while you're alive and in years when you need that extra tax bump. And then estate plan distributions, lifetime income for heirs, asset transfers after death. Certain types of assets can transfer better at death in a tax advantaged way, others don't. And so understanding how those pieces all fit together is a critical component. Again, we can talk to you about pieces of it, but I'm not an attorney. So you want to have your attorney involved in this as well. And by having the attorney involved, you can actually make a good outcome for your situation and for future generations as well. We finally have a phenomenal video editor, and we have great turnaround time now within a week or two for each video. And so those are all being loaded up onto the website. So if you haven't been to our website, you can go to the educational videos area. You can watch this again, or if you missed it, you missed last month, for instance, you want to come back and look at it, you can do that. And now that we have this in place, we're going to be doing some other quick videos with other pertinent information without having to have a full webinar that we can load up there and then send you a notification that says, hey, check out this new video that talks about whatever that's going to be, taxes or planning or insurance options or whatever. Things to help you be able to manage wealth wisely, because that's really our next big step is educational videos. We're building a YouTube platform, so you'll be able to see them that way if you want to. There's several really good things coming down the road. I'm going to save all that for the next time, but I just wanted you to know that our videos are now being uploaded very timely, and our editor is doing a fantastic job editing them. And she fixes all my mistakes, and I love that. And so consequently, I just wanted to encourage you to watch some of these videos to stay caught up on what we're doing and what you're doing and how we can help you maximize what you're doing, where you are, where you're going, how that all looks as we go down that road there on the financial journey. All right, so if you have questions, this is the place I'm showing you this so you can start typing in your questions in the chat or raise your hand, and I'll go back and check that in a second. For the moment, I wanted to let you know that our next Wealth Advisor Review will be on September 16th. It'll be the third week of September. So on the 16th, block it off in your calendar so you can catch up. Hopefully, everything is going to be wonderful like it is right now in the markets and the economy. If it's not, well, we'll tell you the new stuff as well. But this is our way to sort of help everybody stay on board with where we are, what we think is happening, and to make it so if you have questions, you can feel free to say, hey, something you said in that advisory review didn't set right with me. Can you tell me more about that? And I'll be happy to go through that with you. During that time, we're going to do is always talk about planning, talk about market and economic issues, talk about fundamentals and strategies and ways to make the most of what you're doing. So as I said, my goal today was to go over the market and economic data, which we did, to remind you of planning and our strategies for that through the financial dashboard, talk about President Trump and how what he's doing is impacting the economy, the markets, and specifically even yours and my wealth. We talked about the 2025 One Big Beautiful Bill or Tax Cut Jobs Act. Talked about the year-end tax planning we'll be moving into for the next quarter. Even as we're doing our transfer from Pershing to Fidelity, we're still going to keep doing all those meetings. So be prepared for a phone call. Big announcement. And I'll tell you what, I really should have called this big announcement phase 1, because we actually have 2 more phases we're going to be introducing here. We're going to get the Fidelity thing taken care of first, and then I can't wait to share with you some new things that are coming. And now with that, I'm going to go back to your questions. Let me just see what we got going on here. If anybody has any questions. Oh, yeah, here. Oh, there we go. Okay. Okay, so we got a question here. What are your thoughts on quantum computing stocks? Wow. Do we have to dive into the deep end right away? Okay, so let's talk about that. I'm going to tell you that it is, like many people, I'm learning and delving into it and going to make a lot of understanding here for a lot of information so people can understand it. So here we go. Let's talk about AI first, because quantum computing is certainly going to be connected to AI. Let me suggest to you, the first thing I want to say is this, is that for our current tech situation. No, I'm sorry, I'm kind of formulating thoughts as I'm talking, which is always not the best thing to do. There's a lot of similarity between the internet back in the late 90s and early 2000s, that whole stock market tech bubble, and where we are today. Now, I didn't just say we're looking at a tech bubble, although I wouldn't be surprised if somewhere in the next few years, we don't have some of that. Because what happened was, if you remember, you go back to the late 90s, we didn't really understand what the internet was. We tried to, some of us understood more than others, but it was still kind of like, we've never seen anything like this before. Email and how can companies make money? doing all of these things, and how does the internet work and all of that. To that point, if you look at the beginning of that whole tech bubble, way before the bubble burst, what you find is that a huge amount of money went into all of the infrastructure, whether it was computers, hardware, software, power sources, buildings, and so on. All of that went into that to create that ability to have the internet. But then the next step, once it's in place, is, and it wasn't like, okay, we've done this, now we do this. It was like people were trying to figure out, how do we make money with the internet? How could we take, when we're used to going to the shop down the street or the big box store over here, how do we make money with the internet? And it became very obvious that people were struggling trying to figure out how to make money. When that dawned on people, the bubble burst and people started panicking. What we do, the dot-coms really became very important, that the dot-coms made money, which many of them did. And so it forced a lot of things to happen. But out of that came companies like Netflix and Amazon, Google, and such. And they showed how to take what the internet was providing and to turn it into a profitable model to have a business with. And today, there are ways that people are making money on the internet that you would have never conceived 20 years ago. Today with AI, it's kind of similar. Matter of fact, if you lay the charts over each other, there's a lot of similarity in how the markets are functioning. So with that in mind, here's what I would say. Right now, we are looking at what is called AI, artificial intelligence. But we're about to move into, according to all the experts, AGI, which is artificial general intelligence. And artificial general intelligence is going to be better than AI. It's actually going to be much more expansive. It's going to be much more comprehensive. It will be much more likely to support systems that can make money with AI. After that will come ASI, artificial superintelligence. And the experts estimate that ASI will be able to create compounds and materials and resources that we haven't even dreamed of, that it will be able to design new items on the periodic chart that don't exist, or at least that we're not aware of yet. That sounds super fantastic, except that the problem will still be the same, which is we might be able to create a new compound, but if it's so expensive to get it out of the ground or to manufacture it, that it'll stall. And even though that new compound exists, at least on paper, it won't convert into business yet. So this is where the ability with quantum computing and all of the resources attached to that will become even more necessary, back to a hardware component. Again, not an expert on this, learning like you are, but really doing lots of reading and trying to amass the information to figure that out. I think that as these pieces come together, AI, AGI, ASI, quantum computing, plus a number of other resources, it will become obvious how it's going to adjust how we do business, how our workforce functions, how robotics function, how companies using robotics will function. It will create some really good opportunities, but it will also create some problems with unemployment and industries that will just disappear. That's not terrible. I mean, there was a time when buggy whips and horse-drawn carriages were essential. That whole industry went away and replaced by another industry. So various pieces are going to have good benefit and good outcomes, but there will be some pain and sacrifice and discomfort along the way. And quantum computing will be a big piece of that as it works within the deep development of what all that's going to look like. So simply put, the ideas of what quantum computing plus several other aspects of that bring together probably represent huge investment opportunity, but it's not clear today who that would be or how that would work. And it's very easy to get excited about a company that sounds like they have it figured out, and then later on you realize they didn't. So we're being very, very careful. I wouldn't say cautious. We're being very careful about trying to figure out which companies that are doing this sort of research and development and who are pushing these boundaries, which ones have the ability to make this work. I can tell you that infrastructure is really critical now. The power needs for AI, quantum computing, all the other resources that come along with that are huge. I mean, they may be bigger than what we have access or capability for today. And so there's going to be lots of pieces of that. So we're working with the companies now, infrastructure-wise, that we think will make that work. As far as who's going to turn AI into money-making, profitable corporations, I think that's still up for grabs. And quantum computing is just one more component of that. Simply put, I'd remind you of Beta versus VHS, Betamax versus VHS. There are things that look really good that don't turn out to be so good in the end. So we're being careful. What I would say to all of you is if you find articles on things like this that you think I should look at, send it to me. I'd love to take a look at it and see what I think this means and how I can make this work for you, for me as well. Okay, let's see here. So, okay, question. How is the switch from Pershing to Fidelity different than the switch from AssetMark to Pershing? In some ways, it's no different at all. If we are moving from one investment model to a different investment model in a non-qualified plan, it will create tax issues. The question will always be the same. If we're making this move, does it produce extra gains that make this worthwhile? Because if we let the tax tail wag the dog and we choose something, we stay with something because it's not going to create a tax issue, and we miss the opportunity for something that is doing incredibly well, then later on be like, well, why did we let a few dollars in taxes stop that? Now, if we're doing an in-kind transfer, which means that we're taking security ABC and moving it from a Pershing account to a Fidelity account, the non-selling of the security won't create a tax impact. With AssetMark, it will create a tax impact because we can't use the AssetMark model inside of the Fidelity model in the same way. Having said that, if a client says to me, I want to keep my AssetMark because I don't want to pay taxes on the transfer, then we can do that. It just won't be on the Fidelity platform. It'll have to stay with Pershing. So that'll be a conversation we'll have individually. On the other side of this equation, though, if it's an IRA to an IRA or a Roth to a Roth, it doesn't matter whether we sell the assets and move them to new assets, as long as it stays inside that tax deferred or tax advantaged wrapper, then there'll be no tax consequences for that. It'll only be for individual accounts, for joint accounts, for non-qualified accounts. We'll have to take a look at that and decide what to do with it. So it's really comes down to, do we do an in-kind transfer, which is the security stays the same in the new account, or are we switching out of securities to do something we think is better? And that'll create a taxable event every time we make that change if we think it's worth it. And that'll be a conversation we'll have. So hope that answered that. All right. See, 2 questions. So I answered live. I'm just seeing what that does. I said live there. Okay. All right. I think that's everything. So I don't see any other questions right now. Let me see if there's any raised hands. See any raised hands? So I guess that's pretty good. What time is it here? Oh my goodness, I'm over. I'm supposed to be done by 6:30. I'm sorry. All right. So last piece is, remember, September 16th is the next advisory review. If you want to invite your friends to this, you certainly can. Just email Megan at franksoffice.com and we'll be happy to send an invitation. If you want them to watch this in a week or so when it's uploaded to the website, you can just direct them to the website and they come back and watch it that way. We don't have to know they exist. So there you go. You can let them see it that way. And I'll be introducing some of the other things that we're doing as well to that. So hopefully I've given you everything you need tonight to have a great weekend, a great week and a great weekend, and you feel blessed, and it's all working out well for you. I know I'm having a great time. I cannot wait to share with you some of the new things we're going to be bringing to the planning and the investments and risk management we're doing over the next 12 months. So stay on board, stay with me, ask questions, and we're here for you. To that point, if you have any questions I didn't answer tonight, or you have some new thoughts you want to bring up, please feel free to let me know. Call us, email us. I'm here for you. So with that, I'm going to say, have a wonderful night. God bless. And I look forward to talking to you all soon.